Hello viewers, myself Pxrthhh. Welcome to my channel Trade with Operator. Today we're diving into a pivotal concept that every investor should understand: stop loss. In the game of investing, where fortunes can be made and lost swiftly, having a strategy like stop loss can serve as your best friend in volatile markets, offering you a protective shield during unexpected downturns. So let's discuss a bit more about stop loss orders. Essentially, these are instructions you to your broker to buy or sell a stock when it hits a predefined price. It can be seen as an automatic exit strategy, safety net that safeguards you from massive losses. Here's how it functions. Suppose you purchase a stock at $50 per share and you place a stop loss order at $45. If the stock price drops to $45 or less, your broker will automatically sell your shares, thus capping your potential losses and stopping a bad trade from turning into a financial calamity. One might ask, why are stop-loss orders of such importance? When stock prices are tumbling down fast, it's common for investors to make hasty decisions. A surge of panic can lead to selling at an unfavorable time or holding onto a stock in hopes of a rebound. But with a stop-loss order, emotions are taken out of the equation, making sure you buy your investment plan. However, it's crucial to note that stop-loss orders are not a magic potion. They can't guarantee a sale at the exact price you set, especially in volatile markets. Their purpose is to limit, not eradicate losses. By aiding you to cut losses and run profits, stop-loss orders can be an indispensable tool in your trading toolkit. While sailing through unpredictable waves of the stock market, keep in mind that a strategically placed stop-loss order can be the distinguishing factor between a slight setback and a considerable financial loss. If used judiciously, this tool can help secure your investments and maintain your trading strategy's course. Because at the end of the day, stop-loss orders are essential for protecting your investment capital. Emotions can haze judgment during market fluctuations, resulting in impulsive decisions. A stop strips away the emotional component from trading and ensures you adhere to your predetermined strategy. Now, let's see how a stop loss can save you from significant losses during a market downturn. Picture this. You've invested in a promising stock, but the market takes an unexpected turn. The stock price begins to plummet. Without a stop loss order in place, you might hold on to this declining stock, hoping against hope that it will bounce back. However, hope isn't a strategy in investing. The losses can quickly accumulate, putting a dent in your investment portfolio. But what if you had a stop-loss order in place? This is where the magic happens. As soon as the stock hits your predetermined stop-loss price, your broker steps in and sells your shares. Just like that, your losses are limited, safeguarding your hard-earned capital. Stop-loss orders function as your personal financial bodyguard, stepping in to shield you from the harsh blows of market volatility. They are particularly useful in fast-moving markets where prices can change rapidly and quick decisions are required. However, it's important to remember that stop-loss orders are not a silver bullet. They come with their own set of risks. For instance, in highly volatile markets, the stock price may gap past your stop-loss level. This means the stock could open at a significantly lower price than your stop-loss price, resulting in a larger loss than expected. Additionally, a temporary price dip could activate your stop loss, selling your shares before the price recovers. Hence, setting a stop loss requires careful consideration of the stock's volatility and your risk tolerance. It's also worth noting that stop loss orders don't guarantee a specific sale price. They simply trigger a sale once the stock price reaches your stop loss level. If the market is falling rapidly, you may end up selling at a lower price than your stop-loss level. This is known as slippage. Remember, stop-loss orders are not foolproof. In volatile markets or during gaps in trading, the execution price may differ from the stop-loss price. It's essential to monitor your positions regularly and adjust your stop-loss orders accordingly. Now let's talk about setting stop-loss levels. The ideal stop-loss level varies depending on your risk tolerance, investment goals, and market conditions. The trick is not to set it too close to your purchase price, which could lead to an early exit, or too far, which might result in unnecessary losses. There are several common approaches to setting stop-loss levels, each with its own merits. The first is the percentage-based stop. This involves setting a fixed percentage below your purchase price. For instance, if you set a 10% stop loss on a stock you bought at $50, your shares would be sold if the price drops to $45. It's a simple and popular method, but keep in mind that it doesn't take market volatility into account. The second approach is the support level stop, which is based on technical analysis. In this case, you set the stop loss just below a significant support level, where the stock is expected to find buying interest. This method requires a good understanding of chart patterns and market trends, but it can be highly effective if used correctly. The third type of stop loss is the volatility stop. This takes into account the stock's price fluctuations. A popular indicator used to calculate volatility stops is the average true range, or ATR. It measures market volatility by calculating the range between a stock's high and low prices over a specified period. If a stock has a high ATR, it means it's highly volatile, so you might set a wider stop loss to avoid being stopped out prematurely. These are just some of the many strategies for setting stop loss levels. The key is to choose an approach that aligns with your investment strategy and risk tolerance. And remember, setting a stop loss is only part of the equation. You should also regularly review and adjust your stop loss levels as market conditions change. Volatility stops take into account the stock's price fluctuations. ATR, average true range, is a popular indicator used to calculate volatility stops. It's a dynamic method that allows your stop loss levels to adjust with the ebb and flow of the market. Lastly, let's discuss managing stop loss orders. This aspect of trading is where the art meets the science. It's not just a set it and forget it strategy. Effective management of stop loss orders is key to maximizing your investment potential and minimizing your risk. Firstly, it's important to understand that stop loss orders require regular monitoring. The financial markets are dynamic, with prices fluctuating based on a multitude of factors. As such, what seemed like a sensible stop loss level yesterday might not be appropriate today. Regularly reviewing your stop loss orders and adjusting them to reflect current market conditions is crucial. So, how often should you adjust your stop loss orders? Well, there's no one-size-fits-all answer. It depends on your investment strategy and the volatility of the markets you're trading in. Some traders adjust their stop loss orders daily, while others do so weekly or monthly. It's all about finding a balance that works for you. One common approach is to use trailing stop losses. A trailing stop loss is a type of stop loss order that moves with the market price. If the market price increases, the stop loss level adjusts upwards. However, if the market price decreases, the stop loss level remains the same. This approach allows you to lock in profits while limiting your potential losses. Another tip for managing stop loss orders is to avoid setting them at obvious levels. Many traders set their stop loss orders at round numbers or at the low or high of the previous day. However, these are levels that many market participants are watching, and they can become targets for price manipulation. Setting your stop loss orders at less obvious levels can help avoid this. In conclusion, managing stop loss orders is an ongoing process that requires attention, flexibility, and a clear understanding of the market dynamics. It's a crucial part of a successful trading strategy, and it's something that every investor should master. Managing your stop loss orders effectively can make a significant difference in your trading success. It's not just about setting them, it's about adjusting them to market conditions and your investment strategy. So there you have it, a comprehensive guide to stop loss orders. We've navigated the unpredictable waters of investing, where fortunes can be made and lost, and we've anchored ourselves in the safe harbor of understanding stop loss orders. We've explored the concept of a stop loss order, a risk management tool that's as crucial as it is simple. It's an order placed with a broker to buy or sell a security when it reaches a certain price. It keeps your emotions in check and your strategy on track, safeguarding your investment capital from the unpredictable tides of the market. We've seen how it works in action, how setting a predetermined price can limit your losses in the face of a market downturn. Without a stop loss, you could find yourself clinging to a sinking ship, hoping against hope that it will bounce back. But with a stop loss order, you're equipped with a life raft, ready to jump ship and limit your losses as soon as the stock hits your predetermined price. We've discussed setting stop loss levels, a process that requires careful consideration of your risk tolerance, investment goals, and market conditions. Whether you choose a percentage-based stop, a support level stop, or a volatility stop, remember, the ideal stop-loss level varies for each investor. And finally, we've touched upon managing stop-loss orders, a task that demands regular monitoring of your positions and timely adjustments of your stop-loss orders. It's not a set-it-and-forget-it tool, but rather a dynamic strategy that requires your active participation. Remember, investing is a journey, and every tool you master brings you one step closer to your financial goals. With the knowledge you've gained today about stop-loss orders, you're better equipped to navigate the choppy seas of the stock market. So, cast off the lines and set sail with confidence. Until next time, happy investing. Let's conclude our discussion with this thought-provoking quote. The key to trading success is emotional discipline. If intelligence were the key, there would be a lot more people making money trading. This reminder highlights the significance of discipline and emotional control in trading, rather than merely relying on intelligence. It reinforces the need for practical tools like stop-loss orders, which guide you through the market's ups and downs with a concrete, instead of attempting to predict the market's every move. Your active involvement and inquisitiveness drive our work, and we're ecstatic to be a part of your investing journey. If you gained value from this video, please pass it on to other investors who might find it useful. Don't forget to click the like button if this video added something new to your knowledge bank, and subscribe to our channel to keep up with more trading strategies and investment insights. We have a ton of thrilling content coming your way, and we wouldn't want you to miss a thing. Remember, every like, share, and subscription helps us reach a wider audience. And together we can make the world of investing less intimidating for everyone. So until we meet again, continue exploring, stay invested, and above all, stay safe in the fluctuating currents of the market. Thanks for watching this video. Please don't forget to share, like, and subscribe. Very happy investing.